Now, before I start, I'd like to say a quick thank you to our sponsor, Netwealth. Now, Netwealth's wealth management service combines a comprehensive, low-cost investment solution with access to qualified advisors. They recently launched MyNetwealth, which is a digital dashboard that combines all your savings and investments from multiple providers in one place. Their MyNetwealth's Wealth Planner tool helps you visualize your current wealth and apply it to your future needs. It takes into account various factors such as age, investments, pensions, tax wrappers, and expected contributions or withdrawals, and calculates the likelihood of you achieving your goals. And daily updates make it easy to track the value and performance of your wealth. Now, I've used a demo of these tools, and they provide a great way to introduce high-level cash flow planning into your personal finances. MyNetwealth also provides a library of useful personal finance content, and if you ever need advice or guidance, their highly qualified team is always there to help. You can find out more information about Netwealth and sign up for MyNetwealth in 30 seconds by visiting mynetwealth.com. Please remember, the value of your investments can go down as well as up, so you may get back less than you invest.
Hello and welcome to episode 420 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leaks. Damien, welcome to the show. How are you doing?
I'm good. One thing we did forget to talk about last week, and I've been waiting the entire week to get this into the podcast, is that the Money to the Masses team went and did a pub quiz. Now, I'm not great at pub quizzes, but we did a team outing, went to a local pub, entered the quiz, and just to give you the short version of the story, we absolutely stormed it and won the pub quiz. And a shout out to Joel, and Joel is our newest team member, and I'm not sure, I think he probably answered about 9 out of every 10 questions that we got right, either on his own or he was one of the people who knew the answer to that particular question. So if it wasn't for Joel, I think we would have been a bit more of a Tottenham Hotspur kind of team, mid-table at best, but as it was, we stormed it and surprised ourselves, didn't we?
Yeah, and the ones that he didn't get right, he would have got right had I not leant over and pressed the wrong button, because it was one of these digital quizzes that involves and embraces technology. So we were using our mobile phone to log in on the pub's Wi-Fi, and you could select different answers, and a couple of times, and now I don't drink, so I can't even blame alcohol.
I do think that was probably to our benefit, because a number of the team at Money to Message don't drink, and I think that could have helped us as the night went on, that we were probably the most coherent and also the people who were keenest to press the button first, because you got extra points. But anyway, we won the pub quiz, so if you've got a pub quiz near you, do you want the Money to the Masses team to come and take part in, then do let us know. And before we get on with the rest of the show this week, there's a bit of admin that Andy wants you all to do.
That's right. The energy price cap, the new figures are coming in on the 1st of July, which means that the energy price guarantee, which is the government subsidised 2,500 level that we've all heard about, which is what we've been paying for our electricity and gas, that's going down from the 1st of July, which is good news for all of us on variable tariffs. So make sure that you go and do your meter readings before the 1st of July or up to the 1st of July, so that you know accurate readings. Therefore, you'll be charged the right amount, the lower rates going forward. We can all benefit from doing that.
Yeah, and of course, many people will be on smart meters, so therefore your provider should automatically get those readings, but it doesn't hurt to take a photograph of your meter reading on that day anyway. Right, going on with the rest of the show, Andy, I'm going to tell you what's going to be on it. The first piece I'm going to do this week is an investment piece regarding fund managers that move fund houses. So is it worth following them? And importantly, how does their performance stack up once they leave one fund house for another? Because obviously it does happen, a bit like football managers moving clubs, fund managers do move investment houses. The next piece I'm going to be doing is all about student loans. So there's going to be big changes from September for people who are going to university on how the loans will be repaid. So you want to listen to that because it's quite significant. And the final piece we're going to do this week is relating to mortgages. Now, different from last week, there's been another rate hike from the Bank of England. It was very significant and it caught nearly everybody by surprise. That is the size of that hike. I want to talk about what's going on and really the economics behind that, but also there's been a bit of news that's occurred just before we came on air talking talking about help for people who are struggling with their mortgages that was announced by the government.
Okay, so let's start with the first piece of the podcast then, Damien. We're going to be talking about fund managers. What have we got?
So this piece is relating to a piece of research that was carried out by Morningstar that was published recently, and it's to do with, should you follow a fund manager when they leave one fund house for another? And it's something that happens every now and then. It doesn't actually happen as frequently as you think, because when I've looked at the numbers going back over time, I think given the number of funds out there, there's obviously thousands of them, you probably only get maybe 24 big moves that happen in a year. So it's a bit like management of football teams, like I've said. You'll get some big moves. Now, what happens when they move? That's what the research looked into. So Morningstar decided to look at the period from 1990 onwards and what happened to fund managers and their performance in the US and in Europe. So how they compared performance of a fund manager that went from one fund house to another. We're not talking about people who just move between funds within their own fund house. So that happens quite regularly. They might take on another fund, for example, but they actually changed employers. Now, they looked at the performance or based it upon something called alpha, but a particular measure of alpha. It's called Jensen's alpha. Now, alpha is a stat that measures the extra return that's delivered by fund managers on top of benchmark. So that benchmark could be something like the S&P 500. It could be the FTSE All-Share. Jensen's alpha is slightly different, and it's calculated using the risk measurement of different assets. So basically, it looks at the performance of a portfolio in relation to the risk they have taken in that portfolio. So it's a slightly different measure, but all you've got to think about is the alpha is giving you an indication of how well the manager is doing with their investments. So they looked at this alpha and they looked at it before the fund manager moved, so what was going on in their old fund, and then they looked at what happened to that alpha once they'd moved to the new fund. And what was interesting is the numbers showed, I'm not going to go into the actual individual statistics because it doesn't really matter, but the broad summary is more important. In the initial years after the move, fund managers typically experience significant increases in that average alpha, and they in fact showed better performance in those first 3 years after they left.
So if we use a football analogy here, we often hear in football a new manager bounce. Is this the same thing in investing?
It seems like there is a new manager bounce that occurs. It's looking at averages, but what actually started to happen when you looked at the numbers, which is what's quite interesting, is if they had a poor track record before they left and went to the new fund house, did that make a difference? Or if they had a good track record, did they go to a new house and did they outperform? Basically, was past performance an indication of what was going to happen once they went to the new employer? And just like football management, it's not a strong indication of what's going to happen when you move clubs or move to that new employer. But even though most managers would typically do better in those first 3 years after they'd moved, even those that didn't perform better tended to still perform better than the manager at their old club, at their old fund. So they had done better if you looked at their old place of work, so the manager that took over. So in one regard they had done better, but they might not be outperforming the market with the risks that they're taking. What was interesting, this is the big but about all of this, after 5 years everything seemed to even itself out and they start to underperform. And you might wonder, well, why is that? Now, to answer that question, I'll go back and look at some research I've done for 80/20 investor members over time. So this is over the last few years. I've done different bits of research looking at this phenomena of managers moving and star managers, those who are supposedly meant to be the best managers when they move on. And one of the pieces of research I looked at was tenure, so how long a manager had been at the fund. And I analysed the different funds and tenure. I'll just give you the summary, and basically the summary was that among fund managers there is a propensity to take more risk in the early stage of their careers in an attempt to outperform, but then they tend to rest on their laurels a little bit. Also, a long fund manager tenure is not the result of strong long-term outperformance, but it's the cause of it, as the manager benefits from the effects of compounding on early successes. Now, what I mean by that is it's a bit like we're going to keep using that football analogy, but if someone's given the time and they actually have a process and they start to perform well, they basically benefit from the compounding of their efforts over time. And so if you've been in the job for a long period of time, then you are likely to start to outperform your benchmark. It increases those chances. So there are all these parallels we keep drawing with football, but it makes it easier to understand. And fund managers are less likely to outperform their benchmark or their peers later in their career. So long-term outperformance has no bearing on short-term performance either. So that means that just because someone is a star manager over a longer period of time, they could underperform in the short term as well. So if you take all that together, that starts to give you a hint as to what might be happening when you get this manager bounce when they move from one employer to the other. Effectively, they start to take on more risk when they go to the new place, possibly, and they're trying to outperform. They are managing smaller amounts of money. That probably might be easier to do, to invest, because trying to invest large sums is a little bit more difficult, trying to buy into companies, especially if you're investing into smaller companies. And so they benefit from trying to outperform their peers when they're trying to attract money. But of course, then when they start to become successful, they will start to become more cautious. And you start to see that herding mentality that happens with fund managers, which is one of the reasons they don't tend to outperform over the long term, because it's like that herd mentality. You don't want to stick outside of the herd too much, because if you do, you might be underperforming. Then there might be a reason because of your style that might ultimately outperform in the long run, but you're likely to lose your job. So if you stay near the pack, you're measured against your benchmark of your peers often than not, or the same benchmarks that they use. Let's say it's an index like the FTSE All Share. So if you are doing what everyone else is doing, even if that's not great, then you're less likely to lose your job. And ultimately, fund managers don't want to lose their job. So one of the conclusions from this particular piece of research is that should you follow a star manager? Well, the answer is that star managers will often take their investment ethos or bias with them, which they will have embedded in their old fund, but they'll probably take it into their new fund. So what we might have is somebody who's benefiting from investing in smaller companies when they're doing well. It could be technology stocks, whatever they have previously done that has performed well, that may have got them their new job. Then they'll continue to do that. But when the backdrop changes, when the market changes, maybe their investment process is no longer working, the bias changes. Just look at last year, technology stocks didn't do very well. Then they might underperform. The other thing we then also looked at was luck. So we dealt with this in podcast 134 if you want to listen to it. But of course, you can also take out a free trial of 80/20 Investor and read the full research that looked at luck's part to play in investment manager performance. Now, I'm going to give you the summary. We found that 90% of funds don't show any level of consistency in their returns. And actually, those that outperform normally had a strong conviction or a narrow investment mandate, which, whether by luck or judgment, the prevailing market conditions were favouring. And while you can't make your own luck, you can increase your chances of outperforming by keeping your charges below 1%. So there seemed to be a link between low charges and actually starting to outperform over the long term, which does make sense. So when you take all of this together, what it shows is that when fund managers move, the reason you might buy the new fund is down to a number of factors, but you shouldn't be just because who's running it. You should look at it in its own merits, what the charges are, how they're running the fund, and there's no guarantee they're going to outperform. In fact, over the long term, they start to do what most fund managers seem to do. They start to move towards the herd. They don't necessarily outperform over the long term. Different managers' biases or their styles will have their day, and they may be having their day in the sun right now, but then at some point they might not. So overall, it's another reason why you should review your portfolio regularly. And so when I do 80/20 Investor, I run my own portfolio live on the site, and I regularly will make changes to my portfolio and explain why. In doing so, it means that I try to take advantage of managers, funds that are performing well in the current environment rather than being loyal to them over the long term, because ultimately your loyalty isn't paid back. And of course, don't forget, history is littered with a number of famous fund managers that were the darlings and outperformed, and people followed them, and they have subsequently lost money and funds collapse. So if nothing else, it is a reminder as to why you shouldn't just follow any fund or fund manager blindly.
Okay, interesting stuff. So we will put the Morningstar research that you mentioned in that podcast piece into the show notes as usual. Right, let's move on to the next piece of the podcast then. We're going to be talking about student loans. There's been big changes. Damien, what have we got?
So the headline on this is that students starting university in England in September could end up paying thousands of pounds more to study than in the previous years. So there are big changes going on to student loans, and it could ultimately mean that most students end up being taxed for their entire or a large part of their working lives as a result. So I'm going to go through the details. We have got an article on the website, we'll link to it in the show notes, about all the changes, and it would explain in detail what's going on, but I'm going to run through them. So the upshot is, for the 2023 intake, they can expect to spend longer paying off their debts and face higher monthly payments once they start earning. Now, the changes were first announced back in February of 2023, and we are now sort of doing it on the podcast. All the details are out. I want to compare what's going to happen in September to what's going on now. So for students currently, they will be on what is known as a Plan 2 loan, and new students will be on what is going to be called a Plan 5 loan. Like I say, there are notes to this that give you all the details. Now, students who started before September 2012 will likely be on something called a Plan 1 loan, but as I say, we're going to look at the difference between Plan 2 and Plan 5. Now, the first big difference between Plan 2 and Plan 5 is the point at which you start paying the loan back. So someone on Plan 2 will pay 9% of their pre-tax income above the threshold of £27,295, whereas going forward, students will have that threshold reduced to £25,000. That's on Plan 5. So students from September will start paying back their student loan sooner than current students will do. So none of these changes are retrospective. They're not impacting existing students. Now, this means that if you earn £30,000 a year, you would pay £243 a year. Currently, students are repaying, but from next year, when students eventually start to repay their loan, they'll pay £450 a year. And if you earn 27 grand a year, you'll pay back nothing on the existing Plan 2, but £180 on Plan 5. So it's quite a big difference. You're going to start paying sooner. The other big difference is the increase in the maximum term. So currently the debt is wiped off. So student debt is wiped off after 30 years, whether you've repaid it or not. So people would often refer to this as a student contribution, because it was really seen as you were contributing to the cost of your education. But if you didn't obviously repay it, you hadn't earned enough over your career, then it would actually be wiped clean. And so there'll be a lot of people who wouldn't ever repay their student loan. And in fact, it was only around about 20% of students ever would repay their entire student loan. This is changing because under the new regime, the term is going to be 40 years. So your student loan is only wiped after a 40-year period. Now, if you work out the numbers, you will work out that that means that most students will still be repaying their student loan when they're in their 60s. And so it means they'll be paying it for longer, but it will also increase the number of students that will likely end up repaying their loan in full. Under the new regime, it will mean, in fact, that more than half of students will end up repaying their full loan when they've done the analysis. And the third thing that is different about the new regime is the interest rate that's going to be charged. It's actually lower. So currently it's RPI plus 3% for people who are under Plan 2, but under Plan 5, that will be just RPI. But of course, for students, they don't worry about repaying their loans until the April after they leave university, but it is something to bear in mind. One of the best illustrations of the impact for students repaying their debts is actually been Martin Lewis came up with a stat, so I can't back this up. But under the current system, the state pays 44p in the pound of every student loan when they're repaying it, and the student pays 56p on average. Under the new system, he claims that the state will pay just 19p in the pound, and the student or graduate will pay 81p in the pound on average. So what it means is the onus of repaying student loans is shifting massively towards the student and away from the taxpayer. So that is a significant change. And when you think about it, for some people who obviously leave university and let's say that they end up earning above that threshold of £25,000, they could have an extra 9% tax levied on their earnings throughout their career, which is obviously significant compared to somebody who didn't go to university. So there are going to be a lot of people who now look at whether it's financially worthwhile going to university, but of course it's still the system that if you don't earn enough, you won't have to start repaying. So there is still that element, but there are changes to the system that people will want to think about. As I say, we've put a link in the notes of this podcast so you can find out more about what's going on and how the system works, but it is something to bear in mind, and it's not something that's been widely publicised as yet. And we will, if people want us to, we can do more on the podcast as we get closer perhaps to September this year about student debt and the system that's going on and how it all works.
Okay, so let's move on to the last piece in the podcast then. Now, firstly, before we move on to you, Damien, you're going to be talking about the mortgage market. Some news came out literally just before we came to do this podcast, something the government has done to help mortgage borrowers who are actually struggling with everything that's going on. So I'm going to quickly cover that now. There was a few interesting pieces that came from that. Now, the Chancellor, Jeremy Hunt, has agreed with the banks and the lenders that a grace period is going to be given before repossessions start to happen. And that grace period is going to be 12 months before any proceedings start to take place. Now, obviously, there's going to be more details on this. It's going to be fleshed out. And as we get the information, we will write more. And potentially, if people want it, we can cover it on the pod. And Jeremy Hunt also agreed that people can now go to their mortgage lenders and talk about their options if they're struggling with their repayments without it having any adverse effect on their credit ratings. And finally, it was announced that the banks and building societies should make it easier for people to actually have flexibility in their mortgage arrangements. For example, they should be able to move over to interest-only plans and extend their mortgage term without any implications. And crucially, they should be able to reverse back from, let's say they went on to their interest-only mortgage, they should be able to come back onto their old repayment mortgage. I mean, these details are going to be fleshed out. Dan, what's your initial thoughts on this?
I mean, the last bit, they were supposedly meant to be able to do that within 6 months. So the idea is nice in principle. There's a very lack of detail. And so whenever these things come out, I always sort of reserve judgment until I see how it's actually going to work in principle, because the one thing I think they're trying to tackle is there are lots of people out there who understandably won't make decisions or will refrain from speaking to lenders for fear of the impact on their credit report, because obviously we talk about credit reports a lot and people are worried about their ability to borrow money in the future. So some people just bury their head in the sand, and they're trying to obviously encourage people to speak to their lenders but put pressure on lenders to help the people who are borrowing money from them, because the government doesn't want to be going in there and bailing out mortgage holders. And that's something I see a lot about in the press, that people are saying that they should be going in supporting people who've got mortgages. And the problem is, this is why I want to do this next section on the podcast. There is an issue with that because of the way monetary policy works, which I'm going to come on to. But in answer to your question, Andy, it's a step in the right direction, but until we see the detail, how does it work? What happens if you have early repayment charges on product? How do you move from one product to another? And like you say, the impact on your credit report. There's so much out there that I'm not quite so sure about, but it's definitely a step in the right direction. So hopefully, if we find out more and it's worth reporting on, we'll do it on the podcast next week.
Okay, so we'll finish off the pod by talking about what's happened this week in terms of the Bank of England raising the interest rates higher than many analysts and even ourselves thought would happen. And Damien, you're going to kind of look at this and sort of break it down, what it means for people and what we might see in the future.
So the Bank of England hiked the base rate from 4.5% to 5%. It was widely expected it would go from 4.5 to 4.75. Now, inflation has proved stickier than people had expected, or the Bank of England had expected, I should say, and it hadn't moved. It stayed the same last month. It didn't drop. So in America, they've seen their inflation rate start to fall, and it's meant that the US Federal Reserve has been able to pause their monetary policy tightening, so raising rates for now at least. Of course, in the UK, we got a very worrying inflation figure before the Bank of England Monetary Policy Committee were due to meet to announce or make a decision on what interest rates would be going forward. That was higher than they'd anticipated. It was higher than most analysts had expected. And as a result, they hiked rates more aggressively. So if you think the last interest rate hike was only 0.25, this represented an acceleration in their hikes. So what they're trying to do is trying to control inflation now by going in hard. And the market had already started to ramp up its bets on how high what they call the terminal rate, so the final interest rate, the highest point that the base rate would get to. They had already been ratcheting that up over the last month or so. So we'd gone from where they thought the base rate wouldn't get much above 4%, well, we obviously got above that quite quickly. They started to bet it was going to be 5.5, perhaps that terminal rate. But now, as we make this podcast, the market is predicting that the base rate will get to 6% by the end of this year, early 2024. So that's a significant jump. And so markets obviously reacted. Mortgage rates have been going up anyway, and so we've seen them move up significantly. I mean, if you're looking even at the best fixed rates out there, they've probably jumped in the last month or so by almost 1 percentage point, and that reflects this issue that we've got in the UK with inflation and how the Bank of England can control it. So one thing is, how is the Bank of England trying to control inflation? And this is obviously a bit of economics. I've talked about this analogy in the past, that if you can drive a car, you can understand how monetary policy loosely works. So when you're driving a car and you've got the rev counter going up, the rev counter goes up, you then change up the gears. If you don't, you'll end up overheating the engine and it'll blow up. If you want to use a loose comparison analogy, think of that as the economy. So inflation is the rev counter, your gear stick are the interest rates you can control, and the engine and the sort of speed that you're going along is the economic growth in the UK. So if we get to a point where inflation is picking up, the Bank of England will naturally start to increase interest rates. A bit like as the rev counter keeps going up and you're accelerating away, you keep moving up the gears. Of course, if inflation starts to fall, then to stop the economy stalling, your engine stalling, you change down the gears, i.e. cut interest rates. So now you get how, broadly speaking, monetary policy works. The issue that we've got in the UK now is that we have interest rate hikes, but they are impacting fewer people than they used to. So back in 1989, because I see a lot of people who may be older writing things like, yeah, well, we had interest rates really high when I was young and now being hiked. We're in a different world to back then. So first of all, in answer to that question, back then, on average, the typical mortgage was only about 4 times the average salary. Now it's about 11.5 times. It's about 11 times actually the average salary in the UK. And that's because of just the way the world has moved on. So people are more leveraged, they have bigger mortgages. And so the 6% rates that we could get to will be feeling like the double-digit interest rates that people had back in the 1990s. Where we are now is already a similar level of pain as people experienced back when rates were hiked very aggressively back in the early 90s. The issue and the difference that we've got now is that back then, in 1989, that was when fixed rate mortgage products entered the UK. And so everybody back then was pretty much on a variable rate mortgage. So when the Bank of England moved interest rates, everybody was impacted who had a mortgage. So when they moved them up, everybody was impacted. And what that does is when interest rates go up, we all know we start feeling poorer because our mortgage rates go up. If you're on a variable rate, even if you're on a fixed, when you come to remortgage, eventually they will go up. So you have less money to spend. You start cutting back on things, and that starts to filter into the economy. You stop buying things. People start saving more money. They put more money in their savings account because you get a better rate of return. And also that starts to happen with companies. So the cost of borrowing goes up, so they stop expanding, maybe stop recruiting. And so what happens is you start to get the economy cool down. The problem we got at the moment is back then, everybody was pretty much on a variable rate mortgage. At the moment, when I look at the numbers, this has changed over time, but when I've looked at the latest charts, only about, I would say, it's looking at the chart here, between 10 and 20% of people have a variable rate mortgage. Everybody else is on some kind of fix, between a 2-year fix and a 5-year fix. And so that has a significant impact. What it means is that fewer people are being impacted by the rate hikes that are going on than they were previously. And if you look at the population, so households in the UK, I think it's around about 28 million households. Broadly speaking, it isn't quite this. I've got the numbers in front of me, but just to make it easy for people to understand, about a third of them are owned outright, so there's no mortgage. About a third have a mortgage on them, and then you've got the rest is split between private rent and social rent. So people in private rents are seeing their rents go up, we know that. But when you were talking about mortgage increases directly, it's only impacting about a third of the population. And of course, if we're talking about the mortgages that are out there, only about 20% of that third have a variable rate mortgage. And then if you look at the people who are remortgaging in the next year, or since the beginning of last year, it's just over 1 million people. And so the biggest rate hikes are only impacting a number that's around about 50,000 people a month are remortgaging. So what you're seeing is a very small portion of households in the UK who are experiencing the extreme pain of these hikes, and the majority aren't yet. That's very different to if we go back to the 90s, for example. So what the Bank of England's kind of hoping is there enough pain is put on those people, and obviously there's going to be an impact on businesses, as I said, but enough pain is going to be put on to those people to slow down inflation and have that impact on the economy for us to not have to have high rates for longer. So if I want to put this all in a slightly different way, if you imagine there's a big long conveyor belt that we're all standing on, and at the front of that conveyor belt going towards this sort of abyss, the furnace, like you saw that scene in Toy Story, the people at the front are the people who either are on variable rate mortgages or remortgaging now. And what we're hoping is that as people go along and drop off that into the abyss and into all that pain, is that enough people eventually get to that point and experience that so the conveyor belt stops when it's our turn to get to the front. That's the world that we're in at the moment, which is why I think we're going to be in a period that interest rates are going to be higher for longer, because it's not going to be until the back end of 2024 when 4.4 million people will have remortgaged. Because at the moment where we are, roughly about 2 million people have remortgaged since the start of 2022. And so you can see there's a lot of people still yet to remortgage, but then that's only 4 million households. So higher for longer is likely. When you look at the market where it's predicting rates are going to be, like I said, it's going to be 6%. In 2 years' time, the market still thinks that we're going to be at 5.1%. Of course, mortgage rates that you can get, the fixed rate deals, will depend on future predictions of where rates are going to go and the availability of funding. But the message is that the mortgage landscape and the backdrop, the economics, isn't particularly favourable at the moment for the UK. And we are also in an environment, people might ask, why is the UK seemingly struggling with inflation more than other countries? And it's a whole combination of things. It's partly because of Brexit. Don't forget, it's also partly because of all the monetary policies that we had in terms of loosening. So things like QE that we've had in the past has been one of the drivers of inflation. We've also had the furlough scheme, and we've had the energy help in the last winter. All of that is extra money that's been fed into the system, which starts to push up inflation. Now, there is obviously another school of thought that the current inflation problem we have, not all of it is driven by simply supply and demand in this country. We are importing a lot of inflation. Of course, what happened with Ukraine, it drove up a lot of inflation. And I've already described how raising interest rates is a slightly blunter tool than it used to be for the Bank of England. But also the current problem we have isn't going to be solved by the Bank of England, because some of the inflation that we're getting is stuff that's being imported in. Hiking interest rates isn't going to change that supply side problem that we've got, and some of that is because of the pandemic, and also whether people like to admit it or not. Mark Carney was in the news the other day talking about how Brexit has also been a cause of part of the inflation problem that we've got. So all of that in the round is where we are, and the situation isn't great. Of course, things can change relatively quickly, because obviously if we have a crash, an economic crash, and interestingly markets started to bet that was more likely after the hike the other day, then we would see rates start to come down again, and we've seen that in the past. But you can now understand why there is a pushback over the government helping people with mortgages. Not only would you only be helping a portion of the population, but you'd also be blunting an already blunter tool that the Bank of England has got. And again, to give you another analogy, what it would be like being in a car with the Bank of England raising rates, and they're trying to put the brakes on, they're trying to slow things down. Meanwhile, the government is putting their foot on the accelerator pedal and sort of screaming for joy and basically going to cause a crash. So that is where we are with the economics, why things are happening like they are at the moment, why the Bank of England probably did hit that panic button and go up 0.5%. And does it mean that we could see more hikes in the future? I think it is increasingly likely that we will do, but I think we have to wait and see what the inflation data says. So month to month, keep an eye on the economic data, so inflation data. And also, if you are due to remortgage in the next couple of years, do listen to the past podcast episode that I did. I did a podcast episode number 382 that was done last year, where I talked about a reality check for mortgages and talked about how to prepare for your mortgage going up in the future. And I used the advice that I gave, I live by that, and it's helped me massively as I'm coming through this mortgage chaos like everybody else is. So go and listen to that. We've linked to it in the show notes as well.
Okay, so that's it. We are done for this week's podcast. If you want to get in touch, you can do so in the usual way. It's Damien at moneytothemasses.com. You can get in touch with me too. It's Andy at moneytothemasses.com. Don't forget, we've got all the other bits and pieces right throughout Money to the Masses. Masses. We've got the socials, our YouTube channel, youtube.com/Money to the Masses. Check it out if you haven't. And also the Facebook group as well. It's facebook.com/groups/Money to the Masses.
And we do it every week. And I was saying to you, Andy, before we came on, that so much effort goes into making these podcasts, so much detail from the whole team. The student piece that I've just done was thanks in a huge part to Joel and the work that he's done. The mortgage piece that Andy was talking about, Harvey's gone on, as we make this podcast, writing in the background, something on that. And the research investment stuff, obviously, I was doing. We're all involved in making and editing these podcasts. So it's a lot of work. So please do leave a review, because it will really help the team. It's motivating to the team for all the effort that they put in. So make sure you do that. 5 stars, let us know, and you could get a Money to the Masses mug.
And so that's it. We're done for this week. Damien, all that's left for us to say is until next time.
Until next time.